Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I am your host, Hannah Chapman, and we have been on a little bit of a summer break, I guess you could say, because I was actually on actual vacation for a couple of weeks there. But we're back. We're back for Investment Friday. I'm here with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. Hey, Brad. It's good to
Hello.
see you. I haven't
Good to see you.
seen you in like 3 weeks. It's weird.
I know. Welcome back to the United States.
Thank you. Thank you. If you can hear my voice a little bit, I am getting over what was a head cold and then a sinus infection from all the travel that I did over the last couple of weeks. So it was a little bit of a hairy travel situation, but I won't go into the whole thing here. But every once in a while, you get that like flight canceled and then another flight canceled and then sleeping in the airport. Yeah, we had one of those experiences this time. So whew.
Yeah. Glad you're back, though.
Yes, back safe and sound, have all our luggage. Everything's good. Kids had a great time. Um, I was in Arizona and then San Francisco with my mom. My mom took me to San Francisco so we could go to Muir Woods and see some redwoods, some giant trees, for my 40th birthday. She wanted to take me for a trip. So that was excellent, super fun. And then my husband and I went to Ireland, and that's where we had the travel roughness, but at the same time, Ireland is gorgeous. It was super fun. And I'll share a little bit more about that in the next week or so and share some pictures and some beautiful stuff. I tend to not say anything publicly when I'm going somewhere, right? I'm kind of that, like, you know what, like the people don't need to know when I'm not at my house,
Right.
if our whole family is going to be gone. So I didn't share anything really about it while we were gone, but I'm happy to share more now that we're back. Um,
Absolutely.
all the things that happened. So while I was gone, the market had just like a whole conniption fit, right? So let's talk
It
about
did, but it
that.
also came back.
Hmm.
So it was a conniption fit. And so it went down quite a bit. And now it's come back quite a bit. So we're not quite break even from the time you left, but pretty close. Pretty close. We're coming close to that. So yeah, I mean, part of the reason we had the market started to sell off was a couple fold. There was a couple of reasons. Um, One had to do with the Japanese central bank, okay, and the other one had to do with the growth in the U.S. economy. So, growth in the U.S. economy looked like it was slowing at a more quickly than policymakers and investors had anticipated. So the word recession started popping up again. It has
Hmm.
kind of abated over the past couple of months, and the recession word came out much, much more forcefully over the past couple of weeks. And we had, particularly Monday and Tuesday of last week, were very, very volatile, to the point that the VIX, which is what we call it's the volatility index. It also is considered a fear gauge because when it goes up is typically when people are selling quite a bit. Like the volatility is really, really high. And so generally, it had been trading at 12, and it hit 60, which 60 is a very, very elevated level for the VIX. And so, you know, things got real haywire really, really quickly. Now, the other thing that was exacerbating was the Japanese central bank. So I'm going to back up and explain why the Japanese central bank, has so much to do with U.S. volatility in the equity markets. Um, so there's something called a carry trade. A carry trade is effectively if Juncture Wealth Strategies went to Japan and we borrowed $1 million worth of we borrowed $1 million, but of course it's in yen, right? So it's not $1 million worth, it's 100 times that. So it's 100 million yen, rough. I mean, a little bit. I'm rounding numbers here, so don't check me. So we borrow 100 million yen, convert it into dollars, so now it's $1 million, and then we invest in US stock. Okay. Now, why would we do that? We do that because the lending rates, the borrowing rates in Japan were so much less expensive than in the US. So if you had, let's say, a money market fund at 5%, which we've had over the past year, someone could go borrow 100 million yen, convert it into $1 million, put it into a money market, earn 5%, convert that 5% or convert a little bit back to pay the interest, and you're net ahead for basically almost the whole 5%, because it was almost a costless trade, assuming the currencies stayed the same. Okay. So this is a big assumption that the currency stayed the same. Well, Japanese inflation has been growing, just like in the United States. Japanese inflation has been coming back. So what happens is the central bank started to get more bullish or more hawkish in raising interest rates. In fact, the Monday that Monday where everything got really crazy, the Japanese central bank was expected to raise interest rates quite a bit, okay, in their fight against inflation or normalizing rates, however you want to term it. So when that happens, if you have all this money that you borrowed in yen, which is now going to cost you a lot more, what happens? Well, you want to reverse that trade to pay off your debt so you don't incur those costs. Well, the problem during that time was because the expectation was Japanese interest rates were going up, the Japanese yen appreciated relative to the US dollar. Okay, why does that matter? Well, if I'm the institution that owns US stocks, I have to sell US stocks. They're in dollars, right? Convert it at a weaker dollar to a stronger yen, meaning I'm taking a loss on that conversion, and now I'm paying off the debt. So it's a double whammy. And because a lot of hedge funds, family offices, and institutions are in that trade, they had what we call a carry unwind. So a lot of those trades had to be unwound very quickly. And so it caused an enormous amount of volatility in the US stocks, particularly the ones that were previously the leaders, because that's where a lot of the exposure where they had been invested. So the Mag 7 stocks, Mag 8 stocks sold off quite a bit. And once that all settled out, it started to come back. Additionally, as the last 2 weeks have progressed, we've had better economic data that people realized, hey, this isn't such a bad deal. We're not going down the tube. We're not going into a recession. We're just slowing down still. Things are still okay. And that's why that's part of those two reasons, the unwind of the Japanese carry trade and I guess the assurance or the expectation that we're going into a slow landing and not a recession, again, is what's driving the markets back to parity where they were when you left.
Yeah, what's so interesting even to literally look at the S&P 500 or um this is in no way, shape, or form an endorsement of any stock, but I'm looking at NVIDIA stock right now,
Mhm.
literally just the graph of it. That in the last month, 1 month time frame, it was at $125 per share a month ago, and during that period, right when everything went a little bonkers, it was down to $98 per
Yep.
share.
Yep.
That's a big drop. Today, it's at almost at 123.
Yeah. Yeah.
Right, so
That's what I'm saying. It's almost a round trip.
right, yeah, it's like the graph is, if you look at on the screen, there we
Yeah.
go, just down and up. Um, so super interesting. And we've talked about this on the podcast before, that especially over these summer months and August and September, right,
Mhm.
can tend to be very volatile just on average, right? We
Mhm.
can see these weird swings. Um, and one of the things that I like to, I tell clients, and we can say publicly as well, is that, the stock market has almost never ended the year on its worst day,
Yeah, no.
right?
Mm-mm.
So if we have
Very,
the if
very low probability that it ends the year on its worst day.
right, it and even over the course of the entire year, right? Like if we have a 2-week period where we drop 8%, it's very highly unlikely that we end there for the
Yep.
year. So we are going to have these periods of high volatility, um, and especially in the US right now with the like crazy political climate that we're experiencing at the moment, that's just adding to it, right? That's just fueling the uncertainty, um, even in addition to these other questions that we're fielding at the moment. Um, do you have any data on that, or like what's the typical, because I can't remember off the top of my head. Maybe you can because you're a CFA rather than a CFP. Do you remember what the, like, on average, what's the drawdown in any given year? Like what's the lowest point that we might see on
Well, I
average?
mean, there's an average. Hold on, I'll try to get a chart for it. On average, it's 2 or 3 5% pullbacks per year, 1 10%, 1 20% kind of every other year. And then during bear markets, you can have anywhere from 30 to 50% pullback during that time. So, but I've got a chart from our friends at Crandall Pierce that I believe shows that. So hold on, you can keep talking and I'll
Yeah. Yeah, well, you get that. I mean, I think that it's just so important, to remember that, right? When we have these periods of volatility, when we have those, 5% pullback, that's gonna happen multiple times per year, every single year. And that even that 10% pullback, sometimes that can feel kinda bad. If you're the investor and you're seeing, everything, "Oh my gosh, everything's down 10%," or I lost, 10,000 or $100,000 in my portfolio. Maybe that's, 10% of your portfolio. That happens every single year.
yeah. Yeah. I'll put this up on the screen so the people who are viewing us can see
Yeah.
the numbers.
Even that 20% pullback, I think that's the one that most people get really freaked out about, right? If we see a 20% pullback, just to remember, that happens on average every couple of years.
Yeah. So yeah, I'm looking at the oh, sorry. I'm looking at the box here to the lower right-hand corner. Okay. And it says frequency of declines, bear markets and corrections, 39 over this period, which is about once every 2 years. Okay. So
Mhm.
that's bear market and or corrections, right?
Which a correction is more than 20% or more down,
No,
right?
it's bear markets are 20% or more, corrections are 10% or more,
Okay.
and they don't track pullbacks, but pullbacks is basically anything from 5 to 10. But once every other year, you have a correction or bear market. Correction you have once every 3 years, and bear markets you have once every 6.6 years. Now this is again 2023 where we hadn't really seen one in a while, but the average correction is 14%. The average bear market is 34%. So that's
Mhm.
the average, right? Everybody's recollection in 2008, 2009 was we were down 50% at one point. Okay.
Mhm.
Now we didn't end there, obviously, but at one point we were down 50%. So, is it possible or plausible that we can go down a third? Absolutely. Like that's the normal course of business. That's not extraordinary.
Hmm.
And I think that's something. Now, bull markets, you know, these don't happen. Bear markets and corrections don't happen that often. Bull markets are the general course of business when it comes to the equity markets,
Mm.
and they give fantastic rates of return over the long period, but particularly if you enter during corrections or bull or bear markets. So again, it's one of those things that got to be real careful of. Volatility is just part and parcel to investing, and you just have to be okay with it. It's one of the things we try to mitigate any substantial extended equity market decline for our clients. We try to offset a lot of it. But it's impossible to eliminate it.
Hmm.
So yeah, so quick down, quick up.
Yeah.
Now, what I would say is right now, I don't see anything in the fundamentals of the economy that would suggest that we're in an extraordinary period. In fact, I think we're actually getting to a very normal period where, inflation's between 2 and 3%. Jobs are weakening, but they're still relatively tight job market. And as long as we have jobs and people are working and people are going to spend, and if they spend, the economy is going to do okay. And if the economy does okay, earnings are going to do okay, and earnings drive stock returns.
So one thing that had the kind of the big news that has happened since we last spoke um, on the political front is that Kamala Harris and Tim Walz are now the Democratic presidential and vice presidential nominees.
Yes,
Well, they're
presumptive nominee.
presumptive, right? Yeah, because this will air on August 16th, and the Democratic National Convention happens on the 19th through the
Yes,
23rd,
it's
I believe.
starting this next week.
Yeah, so that's where they will most likely be formally nominated for the Democratic ticket. Um, and so we had kind of speculated around that earlier. And so now it looks to be like that will be the case. And one of the other rumblings that I'm hearing now is that Trump might not be the nominee when it comes to November, like actual voting time. So that it's very interesting to kind of see what's shaping up from what we thought was going to be Trump versus Biden 2.0.
Yeah, it's interesting because during the primary season, Nikki Haley, who was running for president for the Republican nomination, she had said something in January of this year, which has stuck with me, which was the first party to dump their 80-year-old nominee will win the presidency. And the Democrats, conspiracy theories or not set aside, the Democrats had Biden or Biden stepped aside, and Kamala Harris became the presumptive nominee. Additionally, she selected a person for her running mate who I think the Republicans are going to have a hard time debating against, because their narrative is they want to take away all your guns. Well,
Hmm.
Tim Walz is an active hunter, like all
Right.
over the place. He doesn't want to take away your guns. It's interesting because he's a white older man who's a hunter, who was an educator. So he's kind of the ilk of everyone else. He's a common guy. He's a
Hmm.
common guy. And so it was an interesting choice. I was very unfamiliar with him prior to her nominating him. So, obviously I'm trying to figure out how that's going to affect policy and what that policy is going to do to the economy. It's interesting how a lot of their economic policies, both what Trump has announced and what Kamala Harris has announced, are pretty similar. I mean, they're pretty similar. There's different ways they want to go about doing it, but it's interesting. So we'll see how it goes. But right now, and I think it's one of the things you just mentioned, the important thing about this, the next few months is uncertainty,
Right.
right? The more uncertain, the harder investment markets are going to get to be comfortable with growing. Okay. And so the more certainty we have, the better. You know, I part of this part of this jumping up in the equity market from its recent turmoil, I think part of it has to do with the momentum behind the Harris campaign. And I mean, from what I can see on social media, the news, the different polls coming out, um, I mean, the Republicans better do something, otherwise she's going to kind of thump them a little bit. And I don't know if that's good. I don't know if that's bad. It depends on your political perspectives. But what I will say is, again, from a financial market standpoint, we prize certainty above all else. And
Hmm.
so the more certain it becomes that she is going to be the winner, the more the equity markets will feel comfortable growing, because then we can plan for the future. Because the rules, she might have shades of change from Biden, but you can kind of bet that it's along the same lines. And so again, that's a little more certain. Um, if Trump does step aside and they have to nominate a new, that is going to throw the equity markets into a little bit of turmoil. And it's not because the equity markets like Trump. It's just because it's more uncertainty. So
Right.
now the question becomes, who are they going to get? Are they worse than Trump? Are they better than Trump? Who knows? You know, and so that uncertainty, people have a difficulty time committing capital to investment, long-term investment projects, if you don't know what the rules are going to be. And
Yeah.
so that's why uncertainty is a bit of a problem for us.
Well, we will. We're again August 16th as of, when this recording will air. So we will continue to just follow along and see what happens. But I noticed the same thing too, with in the news, social media, the polling is very strong in favor of Harrison Walls, which yeah, is just super interesting. Super the demographics also of, who it's pulling into the fray, the undecided voters, um the never Trumpers, quote unquote, right? The Republicans that wouldn't vote for Trump. If he steps aside and they bring someone in who's more moderate, or who's going to speak more to the middle of the Republican Party versus the far, far right, the way he has, that I think will pull some of those never Trumpers back to the Republican Party. The people
Com-
that are like, I'm Republican, but I'm voting for Harrison Walls because I can't vote for Trump.
Completely agree. In fact, if the GOP was smart, and I mean the national leadership, and I'm not sure they are, but if they were, I mean, the best strategy would be is to dump Trump as your nominee and put someone moderate like a Nikki Haley up, because Nikki Haley, when she was running, gathered a lot of that momentum. I mean, even when after she pulled out of the race, she was still getting 20% of the vote.
Well, yeah,
I mean that's for only one person running to have someone written in or voted for who's not even running for president is a pretty telling indicator. So, you know, if they do go with a more moderate candidate, again, that's going to throw more uncertainty. You know, now is it going to be a race between Kamala and this moderate Republican candidate? That's more uncertainty. That's going to be,
yeah,
you would see the equity markets probably struggle a little bit around that time until we vetted out who this person is, what their policy standpoints are, and how they're, what's the likelihood of them to win office. Um, not it, anything can happen. Over the past 4 years, we've learned anything can happen. So,
Right.
we'll remain agnostic, but observe very closely.
Yeah. A question that just popped into my head as you were talking is what does it do to the bond markets? We talk about the equity markets a lot, but does it have any significant effect on the bond markets, or is that purely driven by Fed policy?
Right now, it's being driven by Fed policy and economic growth. So inflation and labor growth, those two are really driving what's going on with the bond market. You can see the bond market is going into what we call a bull steepener, or at least the expected bull steepener, where that's just crazy jargon for the short-term interest rate yields are going to go down, and the long-term are either going to stay the same or go up a little bit. So the yield curve then it starts to shape up like it does in a typical the normal shape of the curve. Where people get paid extra for locking up their money in a bond for a longer period of time. Um,
Mhm.
you know, so it's interesting because, again, September's coming up. September, the FOMC, the Federal Open Market Committee, is the committee that sets interest rate policy. They're widely expected to drop interest rates by 0.25%. That's a very good thing. I think it's important for everybody to understand how tight policy is. Right now, it's basically neutral. Okay. It's not loose, it's not tight. However, as inflation continues to drop, what happens is nominal GDP growth continues to drop, and that policy that is currently at its neutral level becomes tighter.
Mhm.
It actually will become tighter over time as inflation continues to abate. And so the Fed is really cognizant of that kind of factor. And so they're looking to offset that by lowering interest rates here in September, which we believe they're going to do and need to do.
When is that? Is that mid-September that we'll be watching for that?
I think it's the third week. Hold on, let me I get you the actual date right here.
That will be the big news for that week when we record for sure. Um, and we've talked about this a little bit before too, but it's been a while since we have had rates steady for so long, right? Like you can tell me how many months we've been steady where we haven't had any change. Um, but when the markets expect something, right? If the market expects that we're going to have a rate cut, and if we don't, then everyone just has another fit, right?
Yes, that's a problem.
Then everyone's really upset. Like we're expecting a, 25 basis point or 0.25% rate cut and we didn't get it. So now we're going to take a nosedive.
Yeah, and to be fair, that's okay on the part of the market because Jerome Powell and the FOMC has been very clear about, hey, next meeting, the upcoming meetings, if we get more soft inflation data, we're going to cut rates. They've been pretty clear about that, and in fact, in his last press conference, Jerome Powell actually indicated September was kind of on the board. That was the time of it. Yeah, so it's the third week in September, which is September 17th and 18th, with the
Okay.
decision coming out on the evening of the 18th.
Okay.
So evening Eastern time, afternoon more Western time. So depending on where you live in the country. So that should be the first point. My guess is they're going to skip November, which is the 6th and 7th. So the first week in November, right after the election.
Mhm.
And then in December, if things continue along the same path, they will again reduce interest rates by another 0.25%. It's interesting because as I've watched this year progress with going from the expectation of 6 interest rate decreases at the beginning of the year from investors, going down to only 1 this year, almost none this year at the late spring, early summer, and now we're up to 2 or 3 again. Um, as that kind of progress has happened, I will tell you, my mortgage lender has reached out and said, "Hey, I'm prepping my files for refinancing. So if you can send me your current statement, I'll get we'll get the information flow going. That way, when yields drop to the point on mortgages that you want to refinance, we can do it very, very quickly." So, I don't think there's a refi boom by any stretch, but there are some people over the past couple of years that um, might benefit from a little bit lower interest rates. So it's interesting that the mortgage lenders are already starting to get prepped for that.
Yeah, that was gonna be the next thing that I was gonna, like, kind of pull at a little bit is, like, what w one of the things we've been talking about this year is the housing inflation that we've experienced. It's been pervasive. It's been the pretty much the biggest piece of inflation, especially that, everyday Americans have had to deal with, um, in their own, household costs. And so how quickly does that rate cut filter in to mortgage rates? Is it
Almost instantly.
okay.
Yep, almost instantly. It also flows into credit cards very, very quickly as well. Um, because they're all based on that interest rate plus a spread. And
Mhm,
essentially, as soon as it happens, um, floating rate debt goes down almost, very, very quickly within a week or two, maybe a month at most. Credit card for consumers goes down pretty quickly. Um, Auto loans and mortgages also go down pretty quickly. Um, so we'll see. I mean, I don't think it will set off this huge torrent of activity, but I do think people will start to look at it and go, if we get down into the high fives on a mortgage, everybody's been hearing about the 7% mortgages,
yep,
right? And if people get into the fives, 580, 590, I think people will start to refinance. People that are looking to buy a house will start
mhm,
to think that is a inexpensive mortgage per se, because now that the base mark the anchor is now 7%, not 2.5, which it was earlier this decade. So it's some of those things that people are starting to come to grips with, that mortgages are in a more normal range. Okay, if you have a 2.5% mortgage, fantastic, lock it in, keep it. You're probably never going to see that again unless we have an economic crisis. And
mhm.
that's never a good sign. If you have really, really low interest rates, it's not the sign of a healthy economy. In fact, it's the sign of a very dysfunctional economy. And so I'd get worried about a lot of other things happening other than just the mortgage rate. But again, if you own your house, you love your house, and it's mortgage is 2.5%, good for you. Never sell it.
Right, and that's actually I've seen a lot of, discourse online around that where, people who do have rates in the 2s or 3s, um, which I wanna say my mortgage is around we got it in 2018. I wanna say it's like 4 and a quarter, um, which isn't bad, right, at all. It's great compared to what it has been, but it's not that, like, 2.5% that some people were able to snag. Um, but that's creating, another little bubble of like, "Oh, we're not actually able to move right now because the house we have, if we replicated the house we have, we would pay literally 3 times more for the mortgage because housing prices have gone up and interest rates are quite a bit higher. So it's kind of like locking people in somewhere. I know for my family, we are planning to move in the next year. So that, again, I think it's 4 and a quarter. Um, but housing prices have gone up quite a bit. So it certainly helps to see that, okay, over the next, 6 months or so, we might see rates back in the fives, especially if good credit, you have, down payment, all of that makes it a lot easier to buy a new house. Um, but yeah, I'm curious to see what that does to the housing market since it's been a little bit disjointed lately.
Yeah, my guess is the lower yields, less onerous borrowing costs will help encourage home builders companies to
Mm,
build more houses. I mean, one of the problems over the past 10 years is, and it really stems from the Great Recession of 2008, 2009, where we were building so many houses and everybody was buying houses for, you know, no income credit, right? No income
right.
mortgages and
No money
so,
down.
yeah, it got so overheated that the builders retrenched. And when they retrenched too much. And they've held on to very, very disciplined, but I think they're leaving money on the table, to be honest. I think that if they grow, I think their marginal revenue is still far exceeding their marginal cost, which would add value to their companies. So I think the part of the problem they're in is debt is expensive for building homes, for building new projects. I mean,
Mhm.
you to get a loan like that, it's rare that a bank will do it. You have to go to other finance options to do these big subdivisions. And, you know, again, the lower cost of borrowing, the easier it is to get those loans, the easier it is to build those more houses, and more supply, same demand, your general price comes down a little bit, and that's not a bad thing. That's not a bad thing. People will have to sell and move for reasons other than their mortgage cost. We've
Mhm.
talked a lot about that over the past couple of years, but in the early 80s, when mortgage rates were 15 to 20% range, um, activity still happened. People still bought homes. They still sold homes. Um, Maybe not at the level they did when things were a little easier, but they still did. And why? Because they were forming households, because they were needing to upgrade their house, get bigger because their family was growing, or um, they were downsizing, they were trying to go into retirement or what have you. uh Life changes force that decision more than the economics often.
Mhm.
um you know Job changers. We've got, in my neighborhood right here, I'm in the midst of Silicon Slopes, and we have dozens and dozens and hundreds of tech companies around me. And a lot of the homes around me are executives of the tech companies. And guess what? Tech companies have had a lot of turnover the past couple of years, and so we've had people sell. And I'm sure that they had mortgages that were very inexpensive, but when you get laid off and you get a new job somewhere else and you have to move, you do it, right? You move.
Right.
So it's still a market, it's still a marketplace, but I think it'll get much healthier over the next 12 to 24 months.
Well, we will be watching and commentating as it all happens. See how things unfold over especially the next few months, here in the US. And as always, it's good to see you, Brad.
Good to see you.
Right? I'm
Welcome
still
back.
Thank you, still alive. Uh, I'm gonna hopefully sound a little bit more normal next week as well. Um, but it'll be interesting to see what comes about. So, as always, if you have any questions, if anything from this conversation sparked, something for you that you want to ask about, you can catch me at Hannah HANNAH. There we go at expansiveceo.com for podcast questions. And Brad, how can people get a hold of you?
Get a hold of me at bhaines, BHAINES, at juncturewealth.com. or you can call our number. It's 480-253-4100.
And just let us know. Let us know what you're thinking about. Let us know what questions you have. And if you have any, you know, I don't know, just any thoughts about any of the current volatility, uncertainty. How are you feeling? That's another interesting gauge to get is like, all right, how are quote unquote normal Americans feeling about the volatility, about stocks? Do you care? Do you see it as a buying opportunity? Do you see it as a something to be worried about? It's really interesting to kind of gauge that. So we'd love to hear from you. And beyond that, have a wonderful weekend, and we will catch you next time. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.